Hi, this is CH. This video is part of a series of videos titled My ABCs or Absolutely Biased Comments on one investment fund per video to share how an individual investor like you and I can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the VanEck Defense UCITS ETF, whose ticker is DFNS. Defense investment is often a taboo. Many banks have minimal coverage in this sector, and financial advisors typically will not mention too much about this topic in fear of being branded as a warmonger who profits from pain and suffering of others. Consequently, there are also very few mutual funds that allocates to defense sector. However, we are but humans, and this is not a perfect world. Conflicts exist in our everyday lives, and all of us use some form of weapons to protect ourselves and to gain benefits. While you can of course argue that a weapon makes a bully, the same can be said that a weapon deters a bully. These weapons can be physical items, or brute strength, or convincing words, or powerful knowledge. Even your pet cat will flash its claws if you pester it too much. At country level, military strength plays a big part in determining how safe your resources are and how much bargaining chip you have when negotiating with other countries. One main reason why the US dollar is the most dominant currency is because the US has superior military capabilities. Most countries today have significant funding into their defense budgets, mainly to ensure that their sovereignty is not being challenged easily. With technology advancements, defense investments are no longer constrained to literally brick and mortar, but also in softwares and systems. Therefore, there is actually a wide and profitable range of stocks to consider when it comes to defense investments. There are not too many ETFs focusing on defense investment. The three big ones in the US listing are ITA from iShares, PPA from Invesco, and XAR from Spider, with AUM ranging from ITA's $6.2 billion to XAR's $2.7 billion. All three of them cover both aerospace and defense sectors though, so you will find names like General Electric and Boeing that are not specifically focusing in the defense sector. Among them, ITA has a very high concentration in the top three holdings, with nearly half the portfolio in it, while XAR looks the most diversified. There are also other newer ETFs that place a high emphasis on cybersecurity, with about half the portfolio into technology stocks, such as NATO from Han ETF and FITE from Spider. I find the VanEck Defense UCITS ETF, or DFNS, more relevant than those others for multiple reasons. It is a relatively new ETF having incepted only in 2023, but has already $2.5 billion AUM, which makes it a very stable ETF size. Exposures are also more pure and focus on defense stocks, with no generic aerospace names to contaminate the exposures. Majority of the holdings are still industrials, and tech only forms about 10% of the portfolio. I will go for a broader cybersecurity fund or ETF if I want more tech in this area. The ETF is also diversified country-wise, with US only 60% exposure. I will cover more of this in the rest of the video. VanEck is a US-based asset management firm founded in 1955 by John VanEck. VanEck has since the start been a thematic investment player, focusing on identifying new investment themes in the market and taking the lead to launch associated investment products, from gold investing to emerging markets to digital assets. VanEck today manages over $110 billion worth of assets across all types of asset classes, with equities slightly over half of the assets. VanEck is best known for its ETF business, primarily US listed, but also in the recent years have been expanding its Europe UCITS offerings. Besides ETFs, VanEck also provides to a smaller extent other mutual funds and private fund solutions, as well as other investment solutions. To understand an ETF, we must understand the index that it tracks. The VanEck Defense UCITS ETF tracks the MarketVector Global Defense Industry Index, or MVDEF. MarketVector is an indexing business founded by VanEck and was renamed from MV Index Solutions in 2022. MarketVector differentiates itself from the big indexing players by focusing on thematic plays and lesser covered markets, and is used as a basis for VanEck's ETF business. The specific index webpage provides a summary of the features of the index, such as size and liquidity requirements and selection criteria. However, towards the bottom of the webpage, there are additional documents, and in particular the index guide and the insights document provides a lot more details on how this index is being constructed and managed. The pure play screening is what differentiates this index from other defense sector related indices. New entrants into the index need to have at least 50% revenue relating to various subsectors relating to military or defense industries. This requirement blocks off companies like Boeing and CrowdStrike that are more commercial than military. Existing components get a relaxed 25% revenue requirement to cater for future company business expansions, and probably also to give MarketVector more flexibility to manage the adjustments. Given the sensitivity of the industry, the index does still apply restrictions and filters relating to controversial weapons that do unnecessary and excessive harm. For new entrants into the index, market cap needs to be at least $1 billion, plus other various liquidity criteria such as free float and trading volume. The market cap requirement blocks off small cap companies from the index, so you won't see a long list of small companies at the tail end in the index, like some of the other indices. Given these requirements, the index tends to be a bit more concentrated. There is a minimum 25 component requirement, and the index currently has 28 components. To avoid single position concentration risk, there is a maximum weight of 8%, and this is implemented during the quarterly rebalancing. MarketVector has 5 subcategories for the index, whereby each component should fall under one of the categories. Besides the broader military and defense subcategory, the rest all have representatives from the 28 components. Sharp-eyed Singapore investors will find a familiar local name in this list. ST Engineering, besides producing the necessary defense solutions for the country, is also a leading ammunitions and weapons manufacturer globally. The result is an index that is more pure play in the defense sector than others. The index currently has 54% US exposure, and the rest are diversified globally in 8 other countries. Only 2 components are technology stocks. Market cap-wise, 17 of 28 components are large cap. However, given the index allocates by market cap basis, the result is an 84% large cap exposure. The VanEck Defense UCITS ETF, or DFNS, tracks the total return version of the MarketVector Global Defense Industry Index, or MVDEF-TR. The portfolio is in US dollars-based currency, though the ETF has sterling, euro, and Swiss franc unhedged listing available in various European exchanges. The ETF is accumulation only, and therefore is not suitable for income-focused investors. The ETF uses a physical full replication approach, meaning it will buy and hold actual stocks in allocations as near identical as possible versus the index. Rebalancing is done on a quarterly basis similar to the index. As such, the ETF currently has 28 underlying stocks. TER is 0.55%, which looks a bit high for ETFs, but is actually norm for a sector-focused or thematic-focused strategy. The ETF was only incepted in March 2023, but now already has $2.6 billion of AUM, which makes it probably the largest Europe-listed defense ETF, and as well comparable to those that are US-listed. While the VanEck Defense UCITS ETF only has about close to 2 years of actual track record, performance so far has been quite stellar. The ETF delivered 88.38% since inception till 27 February 2025, significantly outperforming all other major players in the defense ETF space, as shown in this chart. Also useful to note is that we can observe the defense ETFs in general have had a good run in the past 2 years, delivering on average similar to the S&P 500 ETF. On 1-year basis, the ETF has also stayed in the lead during most times, suggesting the concentrated portfolio with a more deliberate focus on defense stocks has been a good strategy. But of course, delivering 30 to 40% a year cannot be a norm, and we should not expect the VanEck Defense UCITS ETF to have such a high performance every year. The MarketVector Global Defense Industry Index started in 2021, so that gives us 2 more years of data points to assess versus the ETF. Interestingly, the index was basically flat from the start of 2021 to end of 2022, and then performed strongly from the start of 2023 onwards. Looking at the broad equity markets such as MSCI World and S&P 500, we can see that they had a more volatile journey in 2021 to 2022, but ended quite flat as well, while performance started climbing up similarly from 2023 onwards. So what does this mean? I think there are 3 takeaways here. Firstly, the performance displayed by the ETF and the index has been very strong, regardless if we compare to other defense ETFs or the broad equity markets such as S&P 500 or MSCI World. This shows that investing in the defense sector can give good returns. Secondly, there is obviously positive correlations of the ETF to the broad equity markets, but we can see much lower volatility in 2021 to 2022. This potentially makes defense sector a risk diversifier, especially for investors who have too much exposure in technology stocks that are dominating the market currently. Thirdly, the strong returns from 2023 till date, that is almost double of S&P 500, reflects that a concentrated portfolio and a sector-focused strategy like this ETF can generate returns of high magnitude. While the ETF has exhibited strong returns on the upside so far, investors must take caution that drawdowns may be large as well in a severe market correction. With the strong performance so far, some might ask if the ETF price is too high to buy now. As an advocate of long-term investing, and as explained through this video, I can only say that in defense investing in the long run has a high probability of being profitable. Conflicts between humans and conflicts between countries will never end, and countries will continue to increase defense budgets and develop new defense technology and solutions. Just look at the world today. With the new interventions from Donald Trump, can the Europe countries afford not to finally boost their defense capabilities? Will wars in Middle East ever end with so much religious and political disagreements at play? Will naval superiority eventually determine the outcome of the regional sea disputes in Asia? To reiterate what I mentioned at the start of the video, while you can of course argue that a weapon makes a bully, the same can be said that a weapon deters a bully. Defense investment is a necessity for all countries, and therefore, as an investor, there is potential profits to be made in this sector. In this consideration, the VanEck Defense UCITS ETF looks to be a very decent pick for this purpose. This concludes my absolutely biased comments on the VanEck Defense UCITS ETF or DFNS. If you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.